Let's look at some additional current liabilities. Today we're going to look at sales taxes payable and unearned revenues. Sales taxes. We all pay, but we probably have never really considered the implication from an accounting standpoint. When a customer pays sales tax at a store, is it revenue to the store? Some people would say, yeah, sales tax revenue. No. Sales taxes is a tax imposed by the state governments. Currently, the federal government does not have a sales tax, but that is always subject to change. The federal government can decide to have a federal sales tax as well. But currently, there is sales taxes in most states. And again, that is a state by state. So the amount of tax and everything will vary based on the state you're actually located in. In South Carolina, we do have sales taxes, and that's where I am teaching. So, South Carolina, we've got some sales tax. Now, a retail store is responsible for the collection of the sales tax and then simply sending it to the government. So, when they collect the sales tax, we refer to that as a pass-through. They're simply going to collect it, and then they're going to turn around and record it in their books and then send it out to the federal government at the appropriate time. Now, sales taxes are paid out. It would really just depend on the location and your state government. So varying companies have to pay the sales tax at different times, but they must at some point remit all sales tax to the state government. But let's look at an example of how we actually account for sales taxes. You're an accountant that provides services to two small retail companies. For the following events, prepare the entry to record the sales transaction and any related tax for each of your clients. All sales were cash sales. So number one, Parker Company rings up sales. So this is one of your clients. They ring up sales and sales taxes separately in the point of sale system. On March 15th, the registered totals are sales of $41,000 and sales taxes are $3,280. So they ring it up separately, so their sales point of sale system clearly shows how much they had in sales and how much they had in taxes. So let's look at March 15th for this company. Well, remember all sales was cash, so the company would have received cash. Now, how much cash? Well, in this case, notice they ring it up separately, so they would have received $41,000 in cash from the sales, plus they would have received $3,280 for tax. So in total, they would have received $44,280 in cash. Now, why are they receiving cash? Well, there's really two reasons. Part of it is truly sales revenue. So you would go in and you would hit the sales revenue for the amount that was sales. And then you would turn around and say, okay, the rest of it was sales taxes. Now, it is not sales tax revenue for our company. It is a sales tax payable. Again, we are simply collecting it in order to send it to the state. So the minute we collect it as a retail entity, it is a payable. It is a debt that we owe to the government. So we collect it on the behalf of the customer and we remit it to the government. Again, it is a pass-through taxation. All right. Now let's look at the second example, March 15th. Moss Company does not separate the sales from the sales taxes in its point of sale system. The registered total for March 15th was $16,200, which included the state sales tax of 8%. So now in this system, when they ring it up, all it shows us on our register is the total. Hey, we collected cash of $16,200. But we know that in that cash of $16,200, we're including the state sales tax of 8%. So how in the world can we split that into its two components? Remember, it's split into sales revenue and sales tax payable. Well, we know $16,200 is the total. And that total cash represented 108%. You're like, wait a minute, what? Well, remember, $16,200 would include 100% of the sales price, so 100% of the sales revenue, plus 8% of the sales tax would total our $16,200. So what we would need to do is simply go in there, okay, $16,200, and we would divide that by 1.08. So the easiest way to remember it is take your total sales, or your total cash, total sales, however you want to look at it, total receipts. That's even better. So take your total receipts and you're going to divide that by 1 plus whatever the tax rate is. So in this case, it's 16.2 is our total receipts for the day. We're going to divide that by 1.08%, and that's going to come out to, let's see, what does that come out to? 16,200 divided by 1.08 comes out to 15,000. So 15,000 would be the amount of our sales. Well, if 15,000 is the amount of our sales, that means the amount of our tax would be 1,200. And if you really wanted to test that, you could take 15,000 times 8%, and when you did that, you would get 1,200, which would represent your tax. So that's how you would treat that if it was calculated as one number. So you had a receipt that was in total cash of 16.2, and you need to split out your taxes from your sales revenue. Okay? Now let's talk about unearned, the second part. Well, what is an unearned item? Well, unearned revenues, and let me prepare this file a little bit better here for you. There we go. Unearned revenues. There are times when a client pays in advance for future services. So we're going to go out and we are going to collect from our customer the cash before we perform the service. When a company receives payment in advance, we must record this as a liability on our company's books because think about it, we've received cash but we haven't performed the service. So we owe someone a service. They do not owe money, but they do owe a service to the client. Airline companies are a good example of a company with unearned revenues. When our customers purchase a ticket, the airline owes the customer a flight. Since all airline tickets are purchased in advance, the company must record this as unearned revenue until the flight is complete. So when you go out and you buy a ticket, so let's say you use U.S. Airways. You go out to U.S. Airways and you purchase a ticket from them, and you're going to fly 3 months from now. Well, they cannot recognize that revenue, but you paid for the ticket. So they collected your $500 for your ticket. They cannot recognize revenue until you physically fly. So they would have to record that $500 ticket as unearned revenue. So let's look at an example. On November 1st, Parker Airlines sold a round-trip ticket to Jay Barnes for a flight to Aruba for $900. So our airline company is selling a ticket for $900. The flight leaves on December 31st and returns on January 7th. Record the necessary entries related to the sale of this ticket. Well, first comes the November 1st. Do we have to record that? Well, absolutely we have to because our financial position is altered. We're receiving cash. So in that instance, our cash is going to be increased and we're going to debit our cash for the $900. Well, we haven't yet performed the service. We owe a flight, so we're going to call that unearned service revenue, or your company unearned flight revenue or unearned ticket revenue, just depends on the company. We're going to use unearned service revenue of $900. So it's going to sit there. Now, when can we recognize that? Well, it depends on the flights. You cannot recognize the revenue until you have physically provided the service to the client. Well, in this case, we've got a little different scenario. The flight took off on December 31st and returned on January 7th. So do we need to recognize any revenues on December 31st? Well, absolutely. We've performed half of the service. So in essence, we can record half of those unearned revenues. So we're going to reduce our unearned revenue because now we have actually provided the service. And we're going to reduce it in half. We've earned half of that flight, half of that ticket sale. And then we're going to credit our service revenue because once we perform the service, we get to recognize the revenue. It is earned. And there is no question about collectability. We've already collected it. So we get to recognize revenue of $450. Now, when's the next step? Well, one of two things. We can either do it on January 7th. On January 7th, we completed that second leg of the flight, so we can go ahead and record on that day the $450. Or some companies may wait to the end of the period. So say we don't produce financial statements until January 31st. Some companies will go at the end of the month and say, okay, what all flights have we completed in January? And they'll do one entry to record all that revenue. It just depends. In my example, I'm going to say when the flight's done, we recognize it. So on January 7th, once that flight is complete, we would get to recognize the revenue of $450. So those are two brief examples of how to account for sales taxes for a company and how to account for unearned revenues.